All right, let's get right into it. We're talking NTPC. And you might think you know this company, but we need to look closer. This isn't just about being a traditional utility anymore. We're going to break down its really big strategic shift, how it's evolving from being India's thermal power backbone into a full-fledged, integrated energy compounder for this new era.
So, how exactly are they pulling this off? Well, it's all about tackling what the industry calls the energy trilemma. You know, that constant, tricky balancing act between making sure energy is affordable, secure, and sustainable. NTPC's whole strategy for this is what they've dubbed NTPC 2.0.
And this image, well, it lays out the roadmap perfectly. See, you've got the foundation over on the left. That's the legacy thermal business, right? It provides all the operational stability and, more importantly, massive cash flow. And that cash is what's funding the whole journey to the right, this super aggressive push into solar, wind, battery storage, and even green hydrogen.
This brings us straight to the bull case for the company. And really, the best way to think about it is as a story of two very powerful but complementary growth drivers. Let's dig into how this whole thing is built.
First things first, you just can't argue with the macro tailwind here. India's demand for electricity has been absolutely surging. We're talking an 8% compound annual growth rate for 3 years straight. And as the biggest power generator in the country, well, NTPC is naturally the #1 beneficiary of all this growing demand.
Okay, now this is where the strategy gets really interesting. Let's call it the twin-engine growth machine. You have engine number 1, thermal business, which is a high-cash machine. Then you've got engine number 2, the green business, which commands a high multiple. So see, this isn't about ditching the old for the new. It's about a really smart, perfectly balanced energy transition.
Let's spend a second on engine number 1. These legacy thermal assets, they are the absolute bedrock of the company. Their operational excellence is just crystal clear when you look at the plant load factors, or PLF. They're consistently running above 75%, which is way better than the national average. This basically makes them essential for keeping India's grid stable, especially when demand spikes.
And here's the crucial part. These assets operate on a cost-plus regulated model. What does that mean? It means they get a guaranteed 20% regulated return on equity. For an investor, this creates a fantastic earnings cushion, a very, very high margin of safety. It's what you'd call a predictable cash cow.
Now for engine number 2. The real game changer here was the IPO of their green subsidiary, NTPC Green Energy Ltd, or NGEL. This move has been a massive catalyst for unlocking value. It's basically forced the market to completely re-rate the parent company, because now they have to value this green business as its own separate high-growth entity. And the market's belief in this story is growing. You know why? Because NTPC is actually delivering. The goal is a seriously ambitious 60 gigawatts of renewable capacity by 2032. And this isn't just some number on a slide. It's being backed up by huge contract wins, like that recent 5-gigawatt round-the-clock power contract. That's a big deal, because it integrates solar, wind, and battery storage all together. Of course, every story has two sides. So to get a balanced picture, we have to look at the other side of the coin, the main headwinds and the risks that could really challenge this whole bullish narrative. The first big risk is all about ESG pressure. You see, as these big global institutional funds adopt stricter ESG rules, they might actually be forced to sell off their shares in companies with major thermal assets like coal. This kind of capital flight could put a ceiling on the stock's PE multiple, no matter how great its green plans are. The second major risk, well, it's actually on the green side of the business. Renewable energy auctions in India are just hyper-competitive, and all this aggressive bidding, which you can see in that downward trend line, could really squeeze the margins, the internal rate of return, or IRR, on future projects. Plus, there's always that lingering risk of regulators changing the rules on fixed cost recoveries for the thermal plants.
Okay, so that's the fundamental story, the business itself. Now, let's switch gears and see what the price action, what the charts are telling us. We're shifting from the what to the how the market is feeling about it all.
So, taking a big step back with this monthly chart, you can see a really clear long-term bull trend. I mean, after going sideways for years, from 2008 all the way to 2021, the stock finally broke out and started this powerful uptrend. And the recent dip, it found solid support right at that 50-period moving average, that gray line near the 290 rupee level. That's a very, very healthy sign.
Now let's zoom in a bit to the weekly chart for a more tactical view.
That correction we just talked about, it successfully tested the 200-week moving average. That's the blue line there. But what's more important is that the price has just recently climbed back above the 50-week average, that gray line. That kind of crossover is a classic signal that the correction might be over and the main uptrend is ready to resume.
So if we look at this through a specific technical lens, I'm talking about Elliott wave theory, the picture becomes pretty clear. That massive rally we saw starting in 2021, that was very likely a powerful wave 3. And this recent pullback, well, it was a textbook wave 4 correction. So what does that mean for right now? This strong bounce we're witnessing suggests the stock has just started its final impulse higher, a wave 5 advance.
Okay, let's pull all these threads together. We've gone through the fundamental bull case, the bear case, and we've taken a hard look at the technical picture. So, what's the final verdict for an investor looking at NTPC?
This slide really says it all. NTPC perfectly fits the profile of what we'd call a growth at a reasonable price, or GARP compounder. You get the safety of a high dividend yield from its stable, regulated business, but you also get the huge growth potential from its green energy side. It's a really rare and attractive mix of stability and upside.
And to wrap this all up, let's ground our analysis with some hard numbers. The key levels you need to watch are on the downside, support at 345, and more critically, down at 290 rupees. To the upside, you're looking at resistance at that big psychological 400 rupee mark, and then the prior all-time highs around 450. Watching how the price behaves at these levels is going to tell you everything you need to know about who's in control, the bulls or the bears.